Good evening, everyone. I wanted to talk about another trade that we're getting into and share with you some information about another methodology that we're using in our pair trading system. In the last video, we talked about two securities that are correlated when you buy long one security and you sell short the other one. Today we're talking about a slightly different methodology where you are buying long two positions, and this is very much like your 401k or your other investments in stocks, where you buy a stock because you believe it will appreciate and you want to enjoy the benefit of the price growth over the next few months or a few years. So the two stocks that we're talking about are Penn West Energy, PWE, and PGH. Both of them are in the same exact business. It's an exploration of oil and gas, and they're fairly large. They're both from Calgary, Canada. And this is a nice way to get into the natural gas and the oil business. But instead of buying the commodities, you can buy stocks that not only will give you the benefit of any price growth that will happen in the commodity, but it will also give you a boost of dividend. And if you're looking at these two stocks, PWE will give you about 9.6% dividend. This is almost 10% dividend that you will get from the stock in a year. Very, very significant. This is a fairly large organization, $7.6 billion market capital. The other stock, PGH, Penn Growth Energy, again from Calgary, Canada, and this is a $2.7 billion market capital with 7.7% dividend. So really good dividend and really nice way to get into the commodity business. So let's take a quick look at the chart and the price of the stocks over the last 3 years. So PGH, you can see that PGH was running between $16 to $20 for a few years. And then when the market crashed, it went all the way down from $21 or more to almost $4.50. So it went from 21 to $4. This is a really significant crash, and you have to be careful with that. Every time that you are buying a position in a stock, you have to make sure that you have a really tight stop loss order, or you're protecting yourself with some options. But again, from March 9th, when the market has bottomed, you can see that it had a really nice run and it went up to about $10 a share. But what we think that over the next few years or few months, there is a good probability that the stock will go up to $13 and perhaps even to $16 and more. And so you can really think about this stock with a high potential of increasing in value in 30 or 60% over the next few years. But instead of buying this particular stock and wait for the appreciation to happen, what we're doing with pair trading and the pair trading system is we're looking for a correlated stock. And so let's take the price of the two stocks that we talked about, PGH and PWE, and you will see that over 3 years the price action was almost identical. So when the market went up and PGH went up, PWE went up as well. And when the market went down, even that it was very significant decline from 21 to 4, you can see that the correlation between the stock was very high, and the price action was almost identical between the two stocks. And now they're going up, and they're going up together. So with our methodology of pair trading, what we're doing is we're trying to identify the gap, and we're trying to identify the time where one stock is opening a gap compared to the other one. So if you look, for example, at this back in 2007, you can see that the blue one, PWE, went up much faster than PGH. for a short period of time. So what you want to do, you want to make sure that you have less money in the overpriced stock and much more money in your undervalued stock. In this case, it was PGH. And you want to shift the funds over and over again based on the price action between the two stocks. So let's take another example. Instead of buying $10,000 of PGH, what we will do here in this case, we will buy $5,000 of PGH and $5,000 of PWE. And as soon as you have this gap between the two, we will shift funds from PWE to PGH. So if we had $5,000 before, now we will keep only $2,000 on PWE and we will have $8,000 on PGH. Because three things can happen. One, PGH, the white one, will go up. The other thing that can happen is PWE will go down. And the third option is both of them, both of the things will happen, meaning PWE will go down and PGH will go up. So you want to have your funds, much of your funds, in the undervalued stocks compared to the other one. And as soon as you have this crossing, as soon as they're getting to the same point, you want to reshuffle again the funds and get it to parity again, so you have $5,000 on each. So now let's get back to where we are today, and I'm going to look at the 1 month view. And in the 1 month view, you can see that the white line, PGH, opened a really nice gap compared to PWE. So if you had $5,000 in each in this area, what you want to do now, you want to move much of your money from PGH to PWE, again, just to avoid losing money when when the white line PGH will go down, or in a more optimistic view, make more money when PW will go up to catch up with PGH. So this is a trade for the day, and this is basically an overview of our long position in pair trading, and I will keep updating you on new trading in the next few days. Thank you.